Welcome back to the SaaT System Channel, where we explore the intersection of digital trends, markets, and smart wealth strategies. In our last video, we talked about volatility as a tool, how understanding it helps control your emotions, and how dollar cost averaging, or DCA, can turn market swings to your advantage. Today, we're taking it a step further. We are going to break down exactly why volatility is the engine that transfers wealth and introduce you to the SaaT strategy called TDCA or triple DCA, also known as double down DCA or DDCA. This is a disciplined approach designed to make volatility your greatest ally. So if you've ever felt a knot in your stomach during a market drop, this video is for you. We're about to turn that fear into a concrete strategy. Let's get one thing straight. Volatility isn't just random chaos. It's the market's primary mechanism for wealth redistribution. Take a look at this chart of the S&P 500 over the past 20 years. It's been through everything: the 2008 financial crisis, the 2020 pandemic crash, and the 2022 inflation correction. Each event looked like a disaster in the moment. In 2008, markets plunged 57%. Those who sold in a panic locked in devastating losses. But those who held on, or even better, bought more, saw gains of over 400% in the following decade. Fast forward to 2020, a gut-wrenching 35% drop in just 1 month. What happened next? New all-time highs within 5 months. The panic sellers literally funded the returns of calm, strategic accumulators. And again in 2022, a 27% slide shook everyone's confidence. But by 2025, the S&P 500 had roared past 6,500 points. Up close, every downturn feels like the end of the world. But when you zoom out, you see that each dip was actually a launch pad for long-term wealth. This is volatility's true function. It doesn't destroy wealth. It simply moves it. It moves it from the emotional to the strategic, from those who panic to those who plan. Short-term chaos becomes the fuel for long-term compounding. The only question is, which side of that transfer do you want to be on? To understand this, you need to see the market's natural rhythm. Markets move in cycles: accumulation, expansion, euphoria, and correction. Every downturn resets risk and presents a fresh opportunity to those who are disciplined. Big institutions know this pattern inside and out. They accumulate assets when they're stirring the streets and sell them back to the public during periods of greed and euphoria. Meanwhile, media headlines are designed to trigger your emotions, pushing you to buy high and sell low, the exact opposite of what you should be doing. But once you see this pattern, volatility stops being a threat. It becomes your tool. So how do we use this tool? The foundation is a strategy you probably already know: dollar cost averaging, or DCA. It's simple. You invest a fixed amount of money on a fixed schedule, no matter what the price is. When prices are low, your fixed investment buys you more shares. When prices are high, it buys you fewer. Over time, this averages out your purchase price, smoothing your cost basis and turning volatility into an advantage. DCA is brilliant because it removes emotion from the equation and rewards discipline. Now, let's upgrade this. Let's take DCA to the next level with the SaaT System's Volatility Enhanced Strategy, TDCA, which stands for Triple DCA or Double Down DCA DDCA. This isn't for day traders. It's for long-term wealth builders who want to actively harness volatility. Here's how the DCA works. First, you have your base investment. This is your normal DCA, investing a fixed amount regularly into high-quality assets. But here's the twist. You set a trigger condition. For example, when the market drops 10% or 15% from a recent high, you execute your double down. Instead of your usual investment, you double or even triple it for that period. Then comes the recovery phase. As the market rebounds, all those extra shares you bought at a discount act as a powerful amplifier for your returns. Why is this so effective? TDCA perfectly aligns with how wealth is transferred during volatile periods. It systematically turns moments of widespread panic into your personal advantage. By buying more when assets are on sale, you dramatically accelerate your compounding. You're not just weathering the storm. You're using its power to propel you forward. In short, TDCA turns volatility into a profit multiplier. Of course, this strategy demands real emotional strength. Doubling down when the headlines are screaming sell feels completely unnatural. It goes against every instinct. But that's precisely when the wealth transfer happens. The fearful are selling, and the disciplined are accumulating. Over years, this difference in behavior creates a massive gap in financial outcomes. This is the real edge, psychology and patience. But a word of caution, TDCA only works if you apply it to strong, high-quality assets. You can't just buy anything that's down. We're talking about stable index funds like QQSPY or VOO, which track NASDAQ and S&P 500. We're talking about proven market leaders with fortress-like balance sheets. Apple, Microsoft, Nvidia, Meta, Tesla, Google, Amazon. It also works for transformative digital assets like Bitcoin and Ethereum. And don't forget megatrends with long-term tailwinds like AI, blockchain, nuclear energy, and quantum computing. Visit our channel for episodes in depth on these digital trends. Focus on companies with low debt and high cash flow businesses built to survive multiple economic cycles. The quality of your assets is what determines whether volatility builds you or breaks you. With DCA, you naturally buy a few more shares during the dips, which helps smooth out your average cost over time. With TDCA, you intentionally double down during those deep dips. This means you acquire a significantly larger number of shares at a deep discount. The long-term impact? Enhanced returns. Over a 10 or 20-year horizon, the TDCA investor accumulates far more shares at better prices because they acted decisively when it mattered most. And here's why this strategy is more relevant now than ever. The global M2 money supply, basically the amount of money in the system, continues to grow over the long term. This constant injection of liquidity fuels long-term asset appreciation. TDCA leverages both of these powerful forces. The short-term volatility creates buying opportunities, while the long-term expansion of liquidity helps drive growth. So how can you start applying TDCA in practice? It's straightforward. First, pick 3 to 5 high-conviction assets you believe in for the long haul. Second, define your investment schedule weekly, bi-weekly, or monthly. Third, set your double-down threshold. A 10% to 15% drop from a recent high is a common trigger. Fourth, use automation or set alerts to maintain discipline. Don't rely on your feelings in the moment. Finally, review your plan once a year, but otherwise, let compound in time do the heavy lifting. To wrap it all up, volatility isn't the enemy. It's the very heartbeat of the market. And TDCA is more than just a method. It's a mindset. It's about turning fear into opportunity, emotion into logic, and volatility into a powerful engine for long-term compounding. This is how the next generation of investors, powered by data, AI, and discipline, are building lasting wealth in the digital age. If you want to design your own personalized TDCA plan, visit SaaTsystem.com. We have tools, compound calculator, macroeconomic data and analytics to help you turn volatility into your long-term advantage. Thank you for watching. If you found this valuable, please hit that like button, subscribe, and turn on notifications so you don't miss our next video. We'll see you next time.